Alright, and welcome back to another Crypto News Saturday. So, in this video I'm going to talk about this article only. A complete failure of corporate controls, what investors and accountants missed in FTX's audits. Because FTX went bankrupt, but they did get audited, and in fact they got audited by two different entities, which is a little bit weird as well. And looking at financial reports dated June 30, Allison noted, which works at Coindesk, noted that FTX proprietary trading arm Alameda Research had 14.6 billion in assets on its balance sheet, but that its single biggest asset was 3.66 billion of unlocked FTT, and the third largest asset was 2.16 billion more of FTT collateral. Nearly 40% of Alameda's assets consisted of FTT, a coin that Bankman-Fried himself more or less invented. It wasn't an independently traded stablecoin or token with some volume and a market price or actual fiat in a reputable bank. Basically what this means is that as a collateral, it's kind of worthless because it doesn't really represent a steady value. Now, if we go further into the article, you see that FTX and its 160 plus business units all filed for bankruptcy in Delaware 9 days after the Coindesk story that started the conflagration. Now, many entities are in Delaware because it's got a very friendly tax climate. And Coindesk obtained the audited financial statements of West Realm Shares, also known as FTX US and FTX Trading Limited, the combined offshore Bahamas-based entity that includes an exchange catering to non-US customers and Alameda, the proprietary trading operation. The first red flag anyone receiving these reports should have seen is that there were two different audit firms producing them, and that doesn't make sense. Why hire two different firms rather than one to produce an opinion on consolidated results? With the benefits of hindsight, we can see it perhaps suggested that Bankman-Fried didn't want any firm to see the whole picture. And the choice of firms itself is questionable as well, because he used Armanino and Prager Metis, who did do some audits for a few public companies, but none of the size of the complexity of FTX. And on top of that, Prager Metis has a poor recent track record with the Public Company Accounting Oversight Board, and so does the other party, Armanino. So it's a very strange thing to have a business the scale of FTX being audited by two non-reputable companies. And if we look at the big four involvement, which are Deloitte, PricewaterhouseCoopers, KPMG and Ernst & Young, Deloitte has made a name for itself in the crypto-friendly public company world as the go-to firm for guidance on the accounting for crypto investments and transactions. And right before its IPO in April of 2021, Coinbase switched to Deloitte, which audited 6 months of financial information and then joined the previous auditor Grant Thornton in presenting its opinion in Coinbase's first draft registration statement. Now, Deloitte also works with MicroStrategy, who is known for buying lots and lots of bitcoins and who is a very enthusiastic advocate for crypto in general. Now, Coindesk also has evidence based on PricewaterhouseCoopers' own internal systems that PwC had taken steps to limit its services for FTX US to only those allowed for auditors of public companies. And perhaps that was because PricewaterhouseCoopers was helping FTX keep its tax bill at zero given its myriad investments and complex global structure. And that's something the Big Four does for a lot of companies. They try to create the best tax climate possible for those companies so that they keep more revenue. The second red flag for any reader of the 2021 audit reports is that neither the Armanino nor the Prager Metis audit reports for 2021 provides an opinion on the FTX US or FTX Trading internal controls over accounting and financial reporting. You might have seen this before, but the restructuring expert John J. Ray III, who was also involved with the Enron restructure, said, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as I occurred here. And from compromised systems integrity and faulty regulatory oversight abroad to the concentration of control in the hands of a very small group of inexperienced, unsophisticated and potentially compromised individuals, this situation is unprecedented." Completely annihilated the guys in charge in FTX. And the protection for investors, which was created by the Sarbanes-Oxley, which was passed after the Enron-era scandals, requires auditors to provide an opinion on a company's internal controls over financial reporting and for management to provide an assessment of disclosure controls and internal controls over financial reporting. And if you look at the third flag, no taxes were being paid. So despite a combination of enormous siphoning off of firm assets by related parties in favorable tax planning, neither FTX Trading nor FTX US paid any federal income taxes, although they both appear to be profitable. Now, all big companies want that, but it definitely is a red flag if a company doesn't pay taxes at all. And the biggest red flag of them all, for preparers and readers of the audited financial statements, should have been the number of complex, round-trip and utterly confounding related party transactions documented in just these 2 years. The related party transactions at FTX Trading are so numerous that it is difficult to know where to begin to analyze them. And the following are the red flags related to transactions between FTX and a control person such as Bankman-Fried, who was acting outside of his role as owner or control person at FTX. And the related party transactions between FTX US and FTX Trading, so Alameda and the offshore exchange, appear to be limited as of December 31st. Now, the first related activity relates to the role of individuals as liquidity providers, market makers and traders of the firm. Bankman-Fried and other insiders were trading on their own exchange for their own accounts, which is absolutely not done if you look at the traditional banking system. And then another related party transaction that has already been reported elsewhere is the exchange software royalty FTX paid to Bankman-Fried. Now, this software was licensed from a related entity for a fee of about 25% of net exchange transaction revenue, depending on the revenue mix. And the company has licensed the right to the software code and the rights to further develop the technology. Now, the royalties were $250.4 million and $22.7 million, and they were calculated based on 33% of net FTX exchange trading revenue, 10% of net additions to the insurance fund, and 5% of net fees earned from other users of FTX platform. And then another highly unusual and perilous related party activity was the use of related parties to manage FTX currency and treasury activities on an outsourced basis. And those servers include that the related entities serve as conduits or fiat or crypto transactions, maintaining an intercompany account for and on behalf of the company that is repayable on demand, and the provision of the same day conversion of revenue and expense transactions of crypto to US dollars, all at the company's direction. And then we've got another massive red flag, because as notable crypto startups like BlockFi and Voyager Digital ran into financial troubles in the last year, Bankman-Fried often stepped in as a white knight. He swept up Blockfolio, a trading app, reportedly for $150 million in October of 2021. And they did so by entering into an FTX equity for FTT crypto option agreement. And the FTT was created by a related party to tokenize the royalty payments for the trading exchange technology platform licensed to FTX. And with the right to issue 32.5 million of the company's common shares and 1 million in exchange for 20 million FTT tokens to be delivered to Blockfolio's selling shareholders on behalf of FTX. And in the next transaction, it seems someone may have had impeccable timing in taking a receivable off the FTX books and benefiting personally. It is difficult to describe how insane and beyond the pale this transaction is from a fraud risk and conflicts of interest perspective. And then the final one is another transaction that seems to have muddied the waters between the personal interest and professional responsibilities of key executives, because a related party sold 12.8 million of the company's common shares to external investors for a whopping $301.8 million. And this $301.8 million may be the next real fiat cash that company top executives grabbed in a hurry on November 11th, as it belonged to one of them, according to the audit report. So a lot of weird things were happening with FTX. A lot of red flags were there, but nobody seemed to have acted on it accordingly. And now a lot of people got extremely messed up because of the bankruptcy of FTX and the bankruptcy of Voyager and the bankruptcy of 3AC and so on and so on. And one of the last things I want to say is that Coinbase provided a playbook for accounting for the crypto economy, and I'll be sure to link that down below, and make sure to read this because it's a very interesting article as well. So that's the news for today. Stay tuned for more articles tomorrow.